Okay, let's go through an example. We're going to take parent incorporated's results, we're going to take sub LLC's results, and we're going to combine those two into consolidated financials, one economic entity. And in this situation, we're going to have some elimination entries, the normal elimination entries when you consolidate two entities, and we're going to have to layer in non-controlling interest because parent incorporated only owns 75% of sub LLC. So first things first, let's look at sub LLC's results, their income statement. Sub LLC has $540,000 in revenue to $210,000 of expenses, which leads to net income of $330,000. And the breakdown of who owns that net income is parent incorporated owns 75%. So they have $247,500 of net income attributable to them. And then you have a non-controlling interest, the other parties that own sub LLC, they are entitled to $82,500 of net income. I'm strictly not looking at this from a variable interest entity standpoint. We're using ownership to dictate how we're allocating, or the attribution of how we're going to allocate net income and ultimately equity within the financials. So let's flip over to the consolidating income statement. I've got parent incorporated's results for the quarter. I've got sub LLC's results for the quarter. Let's take a look at parent incorporated first really quick. You'll notice there's a line item equity income and sub LLC. We're using equity method accounting for parent incorporated's investment or ownership of sub LLC. If you're not familiar with equity method accounting, your investment in the subsidiary, you're recognizing your pro rata portion of their net income as equity income or revenue on your books, which then ultimately increases the investment on your balance sheet. The entry, assuming net income is positive, you're going to debit your investment on the balance sheet of the subsidiary, and you're going to credit equity income to recognize your portion of the earnings related to that investment. With that out of the way, one thing we need to do when we're consolidating these two entities together is to get rid of the equity income because we're now layering in sub LLC's total results in the consolidated financials. So let's go ahead and remove the equity income from the parent. Next thing we need to do is we need to layer in, or layer out, essentially, the portion that parent incorporated doesn't own of sub LLC, which is 25%. So we're going to take 25%, and it's going to be a negative, of sub LLC's net income, the portion that we don't own, and we're going to back that out of the financials. And one thing you'll notice is net income of the parent and of the consolidated entity are identical. And the reason for that is the parent has effectively already layered in the results of sub LLC through equity method accounting. But when we consolidate the two together, we need to, one, back out the equity method accounting, and then two, layer in the non-controlling interest income. The net result is the same net income of parent Inc. and the consolidated income. Next, let's go to the balance sheet. I'm just going to quickly eliminate some of the normal stuff, the due tos and due froms, and also the equity related to the sub. If you are unfamiliar with the elimination entries, I have a video that goes through normal elimination entries when you're consolidating a subsidiary into a parent. Go ahead and watch. You might want to stop and go and watch that if you don't fully understand what I'm doing here right now, because I'm going to quickly just do that. And then I'm going to eliminate the equity of the subsidiary. At the end of the day, we only want to reflect the parent's equity with a slight nuance because we have non-controlling interest. Okay, so you'll notice I don't balance right now, primarily because I haven't eliminated the investment in subsidiary, but you'll notice even when I eliminate the investment in subsidiary of sub LLC, I'm still not going to balance because I need to layer in this concept of non-controlling interest in the equity section. And just to reemphasize, this non-controlling interest line item in the consolidated financials represents 25% of the net assets, the equity of sub LLC that parent incorporated doesn't own. You're simply taking 25%, and it's going to be a positive, of the equity of sub LLC, and you're layering that into your financials to represent the portion in your equity section that you do not own, because you're consolidating the entire entity, sub LLC, in your books, but you don't own 100%, so you need to reflect the portion of net assets or their equity that you do not own. And you'll notice our difference now is the investment in sub, and we're going to eliminate that, and we're going to balance. I do want to say the investment in subsidiary on parent incorporated's books, normally if you own 100%, should equal the equity of the subsidiary, but since parent incorporated only owns 75% of sub LLC's ownership, that investment is only 75% of the net assets or equity in this situation. So we eliminate the sub, we layer in the 25% we don't own of the net assets, and now we have consolidated financials with non-controlling interest in them. I hope this is helpful. I hope this made sense. I hope I didn't confuse you more. It took me a while to really understand this concept. It's confusing. It can get very technical from here on out, but hopefully this gives you a little bit better understanding of what's happening when you consolidate financial statements and when you have a subsidiary that you do not own 100% of. Have a good rest of the day, and I will see you in the next video. Take care and goodbye.